capital. And Cormac, we were just listening there to the CEO of Danske. They too have their own exposure to the Irish property and the Irish banking sector as well. Just I want to draw on your Irish knowledge as well, if I may. How is the Irish banking sector now in terms of state of play, and I guess with that as well, the Irish property market?
Yeah, I mean, I think Irish banks are clearly on their knees. I would say the Irish property market probably has another 50% downside.
5-0.
Yes, I would imagine. The key problem they have is that they don't have their own currency. And there's a lot of research that shows when your nominal GDP falls below government borrowing costs in any country, you end up getting into a vicious macro circle. And that's where Ireland and the rest of the pigs are currently.
But I mean, Enda Kenny has been getting a lot of leeway from international investors. Last time I looked, I thought their yields were only just over 1% away from Spanish yields. Now, that's not a huge amount to write home about, but for a country which has already had its bailout, 7.5%, compared with, say, the Greeks or the Portuguese, it's not all that bad.
It's not all that bad, but I think it's still around 7%, which is clearly unsustainable given that nominal GDP is, I can't remember the numbers exactly, but nominal GDP is probably around 2 or 3%, so you still have a very large negative gap. The other issues are that we don't know to what extent Irish government bonds have been controlled by the national banks in Ireland and to some extent the ECB. I would argue that current yields on Irish bonds are probably not that representative of fair market value.
Okay, let's move on. You've got a piece of research out today. Tell us about it.
That's right. So I put out a note on the UK banks today, and essentially I would separate them into two categories. I see HSBC and Standard Chartered as emerging market banks, very investable, strong balance sheets, very well positioned globally, and have limited downside if the Eurozone blows up. Conversely, I see Lloyds, Barclays, RBS heavily exposed to the Eurozone. If the Eurozone blows up, which I would put at about a 45% chance, then RBS, Lloyds, Barclays all need something around 21-22 billion sterling of new capital, which is equivalent to about 100% or so of the current market cap, and points to about 30% downside. So, for those that have a decent risk appetite, you may wish to play the domestic UK banks tactically. But for longer-term investors that are looking for high-quality franchises to invest in for the long term, Standard Chartered and HSBC are the ones still on currently.
I mean, one I'd probably venture that consensus has been shown by the outperformance of the two Asian banks already. But my question, when you look at the UK banks specifically, is how cautious or how honest are the UK banks being about the state of the commercial and the residential property markets? Or if you're that worried about Irish property, I would argue that maybe the UK housing market, having fallen maybe 15% from the peak, maybe has another 15 or 20% to go, in which case what does that do to Royal Bank or Lloyds or the others? Yeah,
it's a very good point. I mean, there was some commentary in the press recently about accounting standards and the impact of IFRS accounting, which effectively allows the banks to not forward provision on expected losses going forward. But actually, I'm quite optimistic on the outlook for the UK economy and UK property, and the reason is simple. Bridgewater Associates, Ray Dalio, has put out a really interesting piece on debt deleveraging. And the basic idea is in any country, if you can get nominal GDP growth above sovereign borrowing costs, you can debt deleverage from very high levels. And I would argue, the UK currently has total debt to GDP about 408%. They can do what Ray Dalio calls beautiful deleveraging from that level because they've got nominal GDP growth above government borrowing costs. And if that thesis is correct, then once we get the Eurozone crisis out of the way, then actually UK property and UK banks will do very well.
And a lot of governments, we heard David Cameron overnight, a lot of chief executives from Danske are saying that they're not affected by any contagion from let's call it a collapse of Eurozone banking. But do you not believe after the lessons of Bear Stearns and Lehman's that even the Americans are deluding themselves if we have a major banking crisis, that everybody in the banking sector is contagified or whatever?
Experience is contagion. Yeah, for sure. I mean, there are lots of channels, and the way I see it is if the Eurozone breaks up, then you have FX losses for the banks, you have higher loan losses because of a negative global GDP shock, you have lower investment banking revenues, you have higher funding costs. So there's a clear financial channel, but then also you just have a huge reduction in the amount of trade that's happening. You have a huge increase in risk aversion. So
are they in denial then, as usual, as bank managements, about how bad the bad could be?
I don't think so, because I think that the imminent breakup of the Eurozone is widely known and talked about, and you can be 100% sure that every central bank in the world is preparing, wargaming for this scenario, and basically deciding how much QE they're going to do and how quickly they're going to do it. So, you know, I think is that Bob Farrell has 10 rules of investing, and one of them is when everybody agrees something's going to happen, you can be certain something else is going to happen. So, you know, everyone's waiting for, you know, huge downside if the Eurozone breaks up, but you could see a huge amount of QE so that in the short term we get a very strong rally in risk assets.
Cormac, in terms of those three banks that you said are at risk of this 45% chance of a breakdown, you mentioned RBS, Lloyds and Barclays. The differentiation between the three in terms of the market perception at the moment is one didn't take money and doesn't need to take money from the UK government, i.e. Barclays. The other two did, of course, and hence there was massive dilution. When this event, if this event happens, this 45% chance of the Eurozone breakup, are we talking about private sector investors coming up with that £21 billion plus capital? Is it per bank?
It's per bank, so total is 66
So is it private individual, i.e. is it rights issues, or is it actually Barclays having to take state aid?
Well, I think in reality it would end up being a rights issue open to private investors who would shy away and would effectively have, the capital would almost certainly have to come from the government. I don't think that, you know, for the UK banks in total it's about 83 billion. Which is probably more capital than private investors in the UK have currently.
Okay, we're going to carry on with the Open. Karen, do you want me to carry on talking for a little bit? You ready?
I'd like to just wander over here so you can keep on talking.
Just last minute stuff. Do you know, I sometimes stand at that wall waiting for Cutmore to finish these little chats, and I wait forever. You have obviously got the right policy of just taking a nice seat and relaxing in between.
Although those of us behind the scenes know that's just complete fib, Steve. You get this heavy clumping over here at Daily. Let's take a look at how the MIB is doing in Italy, and in fact just trying to fight it out with Spain for the title of the worst performer, and so far it seems to be achieving that down almost 1